And good afternoon. Welcome to Acis SMSF Update webinar. My name is Stephen Harvey. I'm the Legal Services Director at Acis, and I'm here to introduce Peter Johnson, who's our SMSF Services Director. Peter has extensive experience in self-managed super funds as a chartered accountant and a regular presenter for CPA on self-managed super funds. He teaches superannuation for CPA and Kaplan, and is the chairman of the New South Wales Public Practice Committee for CPA. We're on a fairly tight schedule, so I'll hand over to Peter pretty quickly, and he can take you through the content, and I hope it's useful for you. Thank you.
Okay, thanks heaps, Stephen, and hello everybody. It's very interesting considering there are very few changes made in the budget for this year, being 2018, and when I put together an SMSF update, I thought there's no way in the world we're going to get through a full hour of changes because there weren't many. But actually, when I did go and put it together, we are struggling to actually be able to fill it up in an hour. So when you have a look at the recording, maybe it will go for a bit longer than an hour and we may have to cut a few things. So what we're going to run through today, all of the changes that have come over in the last 12 months. First of all, we'll look at the phase-year changes, which are the new education and ethical standards for all financial advisors that are advising in the SMSF space. Now, I understand many of you would be deciding not to give advice on SMSFs under the licensed regime, but some of you will be, and some of you will be thinking about it, and it's fairly important to understand the changes. We will look at the changes that were announced in the budget in May and those things that have already been brought in and will be brought in. Some other issues that the tax office have spoken about over the last 12 months, issues that they're seeing accountants doing. We will look at transfer balance caps because there's still a fair bit of misunderstanding around that. So we'll run through reversionary pensions versus account-based pensions, etc. And then at the end, we will have time for some questions. So we will start with the phase-year changes, and it comes in on the 1st of January 2019. Now, unfortunately, the government hasn't actually fully announced what the changes will be from the 1st of January next year. So the changes I'm going to be talking about now are the changes as at today, and there's a very good chance that these changes will come in. So we'll start looking at existing advisors with an accounting degree. So if you're currently an authorised rep or you have your own limited licence, then these changes apply to you. So what will happen for existing accountants who are already an authorised rep? What you will need to do is to complete 3 transitional subjects. Now these subjects are at master's level, and so the first one, once again, here we go again, we have to do a subject in ethics. So they will be requiring us all to do a subject in ethics again. The next subject that we will need to do is consumer behaviour. So
the broadcast is now starting. All attendees are in listen-only mode.
Understand our customers, so they'll make us do a subject on consumer behaviour. And the final subject that we will do is going to be a subject on the corporations law. So the 3 subjects we'll need to do are ethics, consumer behaviour and the corporations law. And we need to do these 3 subjects before the 1st of January 2024. So it's not too big an impost on existing advisors. Now this means advisors who are advisors as at the 31st of December 2018, so at the end of this year. So that's what accountants with an accounting degree who are already advisors will have to do over the next 3 years. Oh, and on top of that, there's an exam, which I'll discuss later. Okay, for existing advisors without a related degree. Now, in terms of all the people that are listening at the moment, this would be members who obtained their accounting qualification either before degrees were required or did the diploma of accounting. So if you don't have a related degree, or if your degree is in something totally different, then what you will need from 1 January 2019, well, you'll actually have 5 years to get this, is you will need to get yourself a financial planning degree or a graduate diploma in financial planning or a master's in financial planning. And you will need to do that before the 1st of January 2024. So this is actually all existing financial planners. So if you know someone that's been a financial planner for the last 20 years and all they have is a diploma of financial planning, then before the 1st of January 2024, they need to get one of the qualifications shown on the screen there. So they've got a fair bit of work to do, and I think you'll find there'll be a lot of retiring advisors. Now, new advisors from the 1st of January 2019. Now, who does this apply to of the people listening today? Primarily, it's all the accountants that aren't yet an authorised rep or have their own licence. So if you're in that position and you're thinking of becoming an authorised rep from the 1st of January 2019, before you can become an authorised rep, you will need one of the qualifications we spoke about, being the financial planning degree or higher. Now, on top of that, and this is the real kicker, you will need a professional year. We don't exactly know what a professional year will entail because all they've said is you'll need a professional year, but it's likely that that professional year will mean that you need to work under a licensed advisor for 12 months. And that's really going to create some problems for self-employed accountants because they may be forced to either employ a licensed advisor that they can work for or to go and work for somebody else for 12 months. So you need to really look at the position you're in. And if you're thinking of becoming a licensed financial advisor, do it before the 31st of December this year, or you've probably decided to never be licensed. Now, on top of this, everybody has to complete a competency exam. Now, for new advisors, you will need to do the competency exam before you can be appointed as an advisor. For existing advisors, we have until the 1st of January 2021 to do the competency exam. Now, the competency exam will not be overly difficult. It's going to be 75 questions or thereabouts. 70 of those questions will be multiple choice and 5 short answer questions. So, yeah, you don't need to worry too much about the competency exam. If you're in, I'm pretty certain that all of us will pass that. Okay, so that's it for the phasea changes. We can take questions on that at the end. Next, we'll look at the budget changes. Now, this was quite small. There were not many changes, thankfully, this year for superannuation. The first one that we're all aware about is the 3-year audit cycle for certain funds. This has not obviously been legislated. No announcements yet as to exactly how it will work, but the tax office have issued a discussion paper. And what we do know so far, that it commences from 1 July next year, the fund must have had no breaches for 3 years in order to be able to elect for the 3-year audit cycle. And it's interesting that the fund has the opportunity to elect a 3-year audit cycle. All lodgements must have been on time for the 3 years. And there are other things that we'll talk about in the discussion paper that may also not allow a fund to elect the 3 years. So the Treasury has released a discussion paper, and we've got up there a link to the discussion paper. But of course, if you just simply Google treasury.gov.au 3-year audit cycle discussion paper, I'm sure that will also take you to the discussion paper. And they are requesting submissions by the 31st of August 2018. And if you are an SMSF auditor, then I would suggest you read this discussion paper because this may impact on you, and certainly consider a response. So the discussion paper, what the discussion paper says is that there are certain key events that may happen to a fund, and with these key events would mean that the fund is no longer able to run the 3-year audit cycle, and an audit must be done in that year. So what are these key events? Remember, this is a discussion paper and this is what they're looking at. But the first one is the commencement of a superannuation income stream by a member for the first time. So if a fund starts a pension, that's obviously not a commutation back and a recommencement, but it's a new pension, then the fund must be audited that year. If there's the death of a member, isn't that funny that if you die now, you've got to be audited? I don't know what sort of punishment they're going to say if you did something wrong, but yeah, you've got to be audited if you die. So go figure. The addition or removal of a member. So if you add a new member, someone retires, you need to be audited. Now, here's an interesting one. The receipt of non-arm's length income requires you to be audited that year. But the question is, how do you know you've received non-arm's length income if you haven't been audited? Because quite often it's the auditor that says, well, I think this is actually non-arm's length income because of the way you are dealing. And so, we think non-arm's length income is a problem there. So you may not know for 3 years that you've got non-arm's length income. And then, of course, the problem is, what do you do about it 3 years later? You've made another breach because you've received non-arm's length income and didn't get audited. Commencement or maintenance of a limited recourse borrowing arrangement. So basically what this is saying is that every fund that has an LRBA will need to be audited every year. And we're finding a lot of new funds that are being set up with LRBAs anyway. So the majority of new funds will be getting audited every year anyway. So, and then another one, an acquisition of an asset from a related party. That could be any asset, really. It could be a small asset, but acquisition of an asset with a related party requires an annual audit, and investments, loans, leases to a related party also requires an audit. So finally, in specie lump sum payments to a member. So that's in specie, not cash. Again, we need to know about that. The only thing I would say to those of you that are auditors that wish to make a submission, I was giving some advice to a client the other day where this person had actually moved into their residential premises, and it was very recently, like they just moved into their residential premises in July 2018 in their super fund. And the question was, is that a breach? And my answer was, no, it's not a breach. What it is you've just converted that residential premises to an in-house asset. And so provided it's on full commercial terms, you now have an in-house asset, and the test for in-house assets is 30 June. So if as at 30 June next year, you still have that in-house asset, then the trustee has to put a written plan into place as to how they sell the asset in the following 12 months. Now, this was a holiday house that the members decided they wanted to now move into and own and take it off the fund. And it's interesting that there was no breach, provided the members buy this property off the fund before the 30th of June, I think, 2020. So they've actually got a long time without breaching. But if this is not the acquisition, I guess it's a lease with a related party. But if they don't realise this and the auditor doesn't get to them for 3 years, where they could have not had a breach, they will now have a breach because they didn't fix it within the following 12 months. So I think this is a negative to the 3-year audit cycle, and I would really suggest that the auditors that are going to put in a submission consider doing it on that basis along with other bases. Now, with the discussion paper, they've also, and people making submissions, they've got some questions that they want people to consider to answer when making submission. Now, the first one is, how will fees change? And I talk to a lot of auditors, and a lot of them are saying to me, well, Pete, we charge $440 a year for an audit, but I would imagine if we're going to have to wait 3 years to do an audit, and then we're going to start auditing stuff that's 3 years old, and we have to audit 3 years worth of accounts, there's going to be more work in the older audit that's 3 years old than there is in the current one. So I would actually expect that over a 3-year period, the audit fees would go up. So whilst we charge $440 per year, I think our fee would be around $1,650 for a 3-year audit. So it's what I'm seeing is a lot of auditors are actually saying the fees will be more expensive if people elect a 3-year audit cycle. Now, another one, would you consider an alternate definition of clear audit reports should be adopted So you need to think about that. What do we consider a clear audit report? At the moment, people may get a clear audit report, but there's issues in the management report. So maybe we need to go, well, maybe the auditor should have an option of stating there are issues that we see that we haven't breached them on, but certainly we wanted it rectified by next year. So maybe the clear audit report needs to be changed. Now, the super fund annual return, what is the most appropriate definition of timely submission? I think we'd probably leave with that being the due date for lodgement of the annual return. I don't see really why we would need to make it any earlier. It makes it harder for us as accountants to say we want it to be in by March because we like doing the super funds at the end. Now, what should be considered a key event for an SMSF that would trigger the need for an audit? And we saw the key events before. If you think that we've left something out in that list or the tax office have left something out, then by all means make a submission and say you forgot a key event and we believe that this one should be part of it as well. And then they want to know which events present the most significant compliance risks. And I think, again, they got a lot of those right, where you're having any dealings with related parties. I think there's nothing up there that talks about collectibles, and I would imagine that if there's collectibles in the fund, then it should be audited regularly. I think also if, well, it says investments in a related party, so that would include a related unit trust, needs to be audited regularly as well. Should arrangements be put in place? You can all read this. I'll leave that up to you to consider. And then, of course, are there any other issues that should be considered in policy development? So that's really it for the SMSF 3-year changes and the discussion paper that the Treasury have released. Okay, moving on to other changes from the budget, and we all saw this one, now expanding the definition of an SMSF, the maximum number of members going from 4 to 6. I'm interested as to why they would come up with that. There was really no sort of indication this was going to happen. Maybe a politician had a situation where he wanted to put 3 kids or she wanted to put 3 kids into their fund, but they could only have 4 and they wanted 5, so they decided to increase the number. Just something to remember here, and it's up on the screen, that trust law in Queensland places a limit on the number of trustees of a trust to 4. And the law goes further to say that where more than 4 persons are named as trustees in the deed or any instrument appointing the trustees, then the first 4 named persons will be the trustees. So I would doubt that anybody listening to this webinar at the moment would actually recommend individual trustees for an SMSF, and if they did, they certainly wouldn't be doing it for an SMSF that's got 5 members. But we know lots of people go out there and don't take advice, and they go online, and the online provider says, do you want a corporate trustee or an individual trustees? And the response to that question is, what's the difference? And the answer to that is $800 difference. So they go, I'll take the cheaper option, and they appoint individual trustees. So these online providers are going to have to make sure that they don't have more than 4 named, where Queensland's the governing state. But then you also have an issue if the super funds in New South Wales fund and it buys a property in Queensland, then you won't be able to put the 5 names on title. That also happens in Victoria. You can't put the 5 names on title in Victoria where it's a trust. So in those situations, you're going to need a declaration of trust. So those of you that are auditors, you can have a bit of fun auditing Queensland super funds with individual trustees that have more than 4 trustees. You'll be able to say they breach section 17A, notwithstanding that the deed looks good. Life insurance changes next. So I like these changes. So life insurance will now be an opt-in, so it won't be automatic. I see a lot of young kids, they've got 3 or 4 super funds, they don't know where they are. 4 years later, they realise they've got 0 balances in all of them because the fund is taking life insurance payments out. So it's a single kid, 20 years old, with 4 life insurance policies and no dependents. Just seems ridiculous, doesn't it? So life insurance will now be opt-in for anybody under the age of 25 years. So my daughter Melissa, she's 21. So now it won't be automatic for her to get life insurance. If she wants it, she'll need to opt in. Of course, she needs to consider TPD as well, and you can't get TPD without life. It will also be opt-in where balances are under $6,000. And I think this is good as well. So even if you're 60, insurance will be opt-in if you've got a balance of under $6,000. Now, this is the kicker, and this is the one your clients need to think about. Life insurance will cease after 13 months where no contributions have been made to the fund. Now, what do a lot of us do? A lot of us actually tell our clients, leave your existing super fund in place because you have good life insurance there, and keep that life insurance going. The risk we run here is your client leaves 20 grand in that super fund and forgets about it, and 14 months later, without realising, they lose their life insurance because the law requires the super fund to cease life insurance unless the member opts in. Now, I'm hoping that the funds will write and go, hey, you're about to lose your life insurance. But again, we all know what clients are like. They get lots of mail, lots of emails, and they tend to not deal with them. So I have a lot of concern in this situation that we're going to get a lot of clients lose life insurance benefits without realising it. The next budget announcement was a work test exemption for people aged 65 to 74 who have recently retired and want to put money into superannuation. So where a person is aged 65 to 74, they have a total superannuation balance of less than $300,000. They then get a 12-month work test exemption. So they can now make a non-concessional contribution to super. I guess they could even make a concessional contribution to super because the work test is just about contributions. So they've got a 12-month work test exemption where they can put money into super from the 1st of July 2019. Now, the only thing then I come back to is if a person's aged over 65, they've got less than 300 grand in super, do they really need super at all? Because they'll be paying 15% tax on the earnings in the super fund unless they're in pension phase, and they probably would also go to pension phase. But on top of the tax, they will also be paying fees. However, if they withdrew the money from super, chances are they'd also be paying no tax and no fees. But you could have a situation where mum's got $1.2 million in super and dad's got 290,000 and wants to do a recontribution or something. But you really need to model whether or not people in that situation need super at all. Okay, the employer shortfall exemption certificate. This is for your surgeons that work for 3 hospitals. And at each hospital, they earn 200 grand a year, which is under the SGC cap. And therefore, each hospital is required to remit 9.5% of their salaries. So that's $18,500 or $19,000 a year from each employer. You've got 3, so you end up putting $54,000 of concessional contributions into super. So the government has now announced that the member can apply to the commissioner for an employer shortfall exemption certificate. So from 1 July 18. Now it's the member that has to apply for the certificate, and it only applies for a single quarter. So it's a lot of work, and worse, the employer is not required to comply with that certificate. If they don't want to, they can still actually remit the 9.5%. So it's going to be difficult to do this, and people need to know about it. That's why I say if you've got surgeons as a client and they're employees of hospitals, maybe give them a call. Another announcement from the budget was personal deductible contributions. Now, people that aren't self-employed from 1 July this year, so from last year, people who aren't self-employed are now able to make to get a tax deduction for personal contributions to super. So therefore they can, claim 10 grand in their tax return, get a deduction for it for personal contributions that they've made. But as we know that they need to lodge a 291.70 notice of intent notice to the super fund, and the super fund needs to have acknowledged that notice before they can claim a tax deduction. And the government's given $3.1 million to the tax office to audit this arrangement. And they've even changed the tax return now, and I'm certain we're late July, so I'm certain a lot of you have seen the tax returns where it actually says, have you received a confirmation from the super fund that this is deductible? And these changes come in from 1 July 2018, and we've probably all seen it. The next one that's very, very interesting from a policy point of view is the superannuation guarantee amnesty, whereby the tax office are allowing you, or the government is allowing you, to pay your super guarantee obligations from previous quarters where you haven't previously met your obligations, and you will not be penalised completely. Most importantly, of course, is this isn't law yet. It didn't get through the Senate before Parliament ceased this year, and as such, it's going to be debated again when Parliament comes back in August, where there are a number of employers that have already made their payments and they're claiming the deduction in last year's tax return. Now, we don't really know what's going to happen if this doesn't get through Parliament, because in theory, those payments will no longer be deductible, and you've just fessed up to the government that you actually didn't meet your SG obligations in the past. Now, the period for the amnesty is 24 May 18 to 23 May 19. So again, it hasn't yet gone through Parliament. It's not yet law, but it applied from the 24th of May 18, which sort of creates a few problems. The really good one, this is from quarters from 1 July 92 until 31 March 2018. So it's actually every quarter for superannuation guarantee from when it started. So it really does. It goes all the way back. This is like the gun buyback. So we don't care what you've done. If you fess up, make the payment now, then we're allowing you to get a tax deduction. Now, you'll still be liable for your shortfall. Obviously, that's what this is all about. You haven't met your SG obligations, so you make the payment. You will still have the nominal interest on the payments, and that's fair because you've had use of that money, and your clients haven't had use of that money, or your staff members haven't had use of that money for all that time. You'll also still be subject to the general interest charge, but you won't be liable for the administrative component, which, as you know, is $20 per person per payment. So, if you've got a few employees, that could be quite a lot. Nor will you be liable for the Part 7 penalty, which may increase your liability substantially. But the really good part about it now, of course, is that your payments are deductible. Now, you could probably see some issues here for someone where the payments were quite substantial. If you owed 10 years worth of SGC from an employee on 50 grand a year, they're going to be way over their concessional cap. So the Commissioner is able to disregard these contributions for concessional cap purposes. And on top of that, these contributions won't count towards your Div 293 income. So it won't add up and go to your income for the year for Div 293 purposes. Nothing was mentioned about whether or not they would be subject to Div 293 30% contributions tax. So that one, I think you may still be up for it. Okay, so that's really it for the budget. There wasn't too much. But there's other things that the tax office have mentioned in conferences when they're presenting. And so we'd like to run through a few of those things. First one now is preservation age is now 57 from 1 July this year, and it'll be 57 for the next 2 years. Now, the really interesting, cool thing about this being 57 now is how many people who turned 57 this year turned 56 last year. And simple answer to that is all of them. And therefore, no one will meet preservation age this year because they all reached preservation age last year. So that's not going to happen. But we're slowly transitioning through to 60 being the preservation age. We've got 2 more years of 57 and then it becomes 58. But you know, a lot of people have still got that 55 number in their head, but now you've got to start thinking 57, 57, 57. Now, T-bar reporting. This is one I'm still seeing accountants make mistakes with their T-bar reporting. It's a bit late for the originals. So for those people that were on a pension 30 June 17 that continued to 1 July 18, so the pension went over the financial year, you had to lodge their T-bar by the 1st of July 2018. Now that didn't matter the size of that pension. So if that pension was 40 grand, you still had to submit it. And there's probably people listening now that are thinking, oh, I didn't think I had to lodge that. Yes, you had to lodge that one. So I would suggest you get that in as quickly as possible if you haven't done it. Now, going forward, so now we look at pensions commencing on or after the 1st of July 2017. So these are still pensions that will be in the 2018 tax return that commenced. The first report for those where the member has a balance of $1 million or more is the 28th of October 2018. So although quarterly reporting came in on the 1st of July 2017, the first quarterly report is not due until the 28th of October 2018, so later on this year. For members that are under $1 million, so if you've got a member with $800,000 and they commence a pension on the 1st of July 2017, your T-bar is not due to be reported until you lodge their annual return and you lodge it with their annual return. So you've actually got a fair bit of time to do the T-bar reporting for those funds. Now, for those, if you're a little bit confused about T-bars, then there is a link to the website. But again, if you just Google Super Transfer Balance Account Report Instructions, it'll take you straight to the instructions. Okay, so what do we report on a T-bar? So we've already talked about income streams that they were receiving on 30 June 17 and carried forward to 1 July 17. Now, we've got this new terminology for retirement income streams. We have retirement income streams can be not in retirement phase, and that retirement income stream is a TRIS before a condition of release has been met. Now, once you meet a condition of release in a TRIS, the Tax Act's been amended to state that that TRIS then either automatically moves to retirement phase if you're turning age 65, or it moves to retirement phase where the fund has been notified that you've met a condition of release. For example, turning 60 and changing employment, turning 57 and retiring, or become totally and permanently disabled, that TRIS then becomes a retirement phase income stream. There's no requirement to commute it back. You're still in this TRIS, but you don't pay tax on the earnings, and you need to lodge a T-bar that you've commenced this retirement phase income stream. Any new retirement phase income stream. So again, if you're in a TRIS, you turn 65, that's an automatic conversion, and therefore you need to report that that is now a retirement phase income stream. If the value is 3 million, you report 3 million, and you've got a $3 million transfer balance cap. And so therefore you have an issue, but it's not a major issue. You're still tax-free on that whole 3 million, interestingly, because you can have a negative transfer balance cap and an actuary wouldn't know that you didn't have one. And so they will still state that that is fully in retirement phase. Now, some LRBA payments need to be reported, and I'll cover the LRB payments in detail. There'll be some advice around what to do with LRBAs in pensions, because you don't want principal repayments being counted as a pension commutation. You need to report compliance with the commutation authority, which really, that's commutation back anyway. So our T-bar lodged because of the tryst saying $3 million, you lodge that, the tax office sends you a notice back stating that we want you to commute $1.43 million back out of this fund. You commute that 1.43 million, you then lodge a T-bar stating that we've commuted it. If you receive a personal injury structured settlement payment and you contribute that to super, you need to actually report that on a T-bar because it actually becomes a debit on your transfer balance cap account. So you get a compensation payout of say $5 million from personal injury settlement, and you contribute that $5 million to super. That becomes, you then have, even if you're in accumulation phase, you now have a minus $5 million transfer balance cap account, which means you can commence a pension with up to $6.6 million without breaching the cap. So I think that's good for those people. I certainly have one friend that's on a $6 million pension who is now a quadriplegic, and we started that pension following a structured settlement payment. Any commutation of a pension needs to be reported. So interestingly, what happens here, if you start a pension with 1.6 million and you say, I'm just going to take, I need 120 grand a year, so I'm going to take 120 grand a year as a pension. Each year you withdraw 120,000. That's not a commutation. So that doesn't get reported. But let's say instead what you decide to do is to start the minimum pension, and your minimum pension's $80,000 a year. And then each June you go, I need more money. So I write to my fund and I say to my fund, please commute $40,000 of my pension balance back to accumulation and then immediately pay it out to me as a lump sum benefit. That then would be a commutation. So it actually then needs to get reported as a transfer balance cap debit. So the first case, the 1.6 million stays as a $1.6 million balance. In the second case, because you're commuting, your 1.6 is reduced by the 40,000 of the lump sum. So you now have a transfer balance cap account of 1,560,000. So you've actually got more money you can put into pension phase later on. Now, we talked about LRBA payments, and where the requirement for T-bar reporting is where an LRBA payment by an SMSF increases the value of the member's interest, then you must make you must lodge that on a T-bar. Now, there's a few exemptions there, so it can only be, well, it's only for LRBAs entered after 1 July 17, so any existing LRBAs are covered. So from 1 July 17, any LRBAs, and it's only where the LRBA payments are sourced from assets not in retirement phase. So what this really means is you've got an LRBA in a fund and it's part pension, part accumulation. This will mean that as you make payments off the LRBA, you will have to apportion part of those payments as transfer balance cap events and add a credit to the member. Now, where you've got more than one member in the fund that are in retirement phase, then you need to apportion the payments to the members. So what really do we say here? We would suggest here that if you're going to run LRBAs, where there's pensions, you separate the funds so that the LRBA is being paid out of a fund that's 100% in pension phase. Okay, so that's what you report on a T-bar. So what do we not report on a T-bar? Pension payments don't get reported. Remember I talked about the $1.6 million one where he's taken 120 grand as pension? That has no impact on your transfer balance cap account at all. You don't worry about investment earnings or losses. And this is where good planning can help your clients. If you start a pension with $1.6 million and then 3 years later, the investment has a windfall gain, such as you owned a property, the property got rezoned and you sold it off for $4 million, and you're sitting now with a pension account with $4 million in it, that doesn't get recorded or reported. So it's really good for that account. What it also says to you is that you really need to make sure that assets that are going to grow are in the pension account, and assets that aren't going to grow are in the accumulation account. But of course, we now understand you can't segregate those two in a single super fund. So there are occasions where you may need to separate the funds and have a pension account and have an accumulation account. If you're thinking of doing that, please talk to us, because the tax office have some concerns of where that could be used as a scheme, and we need to make sure that the strategy you're using is not a scheme. You don't need to report when an income stream ceases because it's been exhausted. So you had a $300,000 pension, you're taking 50 a year, 10 years later it becomes zero. You don't need to report that. It has no impact on your transfer balance cap. Now, here's an interesting one. The death of a member has no impact. We recently had a member that died when they had a transfer balance cap problem. They were over their cap and then they died. We don't need to report their death. So they're going to send a notice to a member who no longer is alive and no longer has a balance in the fund because they have paid their death benefit out. So we're not quite sure what's going to happen with that one yet, but I know that I'll have that somewhere on a video when we get the answer back. But you don't have to report the death of a member. You also don't have to report information that the individuals report directly. This is not going to happen too much for people out there, because this is normally where it's things like a family law payment split, or there is a debit event or structured settlement contributions made before 1 July 2007. That's when the laws, remember, that's when the new rules came in about the limits on the amount you could put in and everything like that. And so if structured settlement contributions were made before that, you've actually got to notify the tax office about it. Okay, so an example of a T-bar and just what we can do, the events that need to be reported. So Peter turns 65 on the 3rd of July 2018, so that wasn't that long ago. At the point of turning 65, he had two separate trisses. Don't know why, but he had one for 1.3 and one for 600. So he's actually over the cap, but he doesn't really realise, because he's got one with AMP and one with BT, say. Doesn't all have to be SMSFs. He decides to take the minimum pension from each, and he decides to receive those pensions monthly. So what we do on the 3rd of July is we report 1.3 and 6. So this could be two separate reports. This doesn't have to be the one fund. This could be two separate reports from two funds, and it goes in and he's at 1.9. He receives a minimum pension, so nothing happens. But then in August, he actually took some advice. Someone mentioned he might be over. So he rolls $340,000 back from the $1.3 million fund. So that gets reported. So now what we can see is that Peter was over the transfer balance cap of 1.6 for 1 month, and he was over it by $300,000. So what the tax office are going to do is they're going to say, right, that 300,000 is now deemed to be earning 10% per annum for 1 month. So it's 30,000 for the year. So it earned $2,500, and you're going to pay 15% tax on that $2,500 for that 1 month. He'll get that bill because of breaching his transfer balance cap. Now, both of these will be notified by the 28th of October 18, and both of them can notify earlier if they want to. He then takes another lump sum of 200,000 on the 1st of September. So there is another 200,000 debit to his transfer balance cap on the 1st of September. And again, that will be reported by the 28th of October. He dies on the 1st of October. So that's it. That's the end of it. No more reporting ever for Peter, which is good. Well, not good because he died, but anyway. Okay, now, reversionary pension versus death benefit pension. This is a big one for transfer balance cap, because everyone's thinking, got to set up a reversionary pension because I want to make sure that we don't breach transfer balance cap issues. Now, Law Companion Report 2017-3 is essential reading where you have clients in pension phase who potentially have a transfer balance cap issue. So I would certainly suggest that everybody goes and reads LCR 2017-3. Another thing that's really important to understand, and I see accountants make this mistake all the time. The SysReg 6.21 talks about death benefits, and it says that a death benefit can be paid either as an interim lump sum, a final lump sum, or one or more pensions. It then goes on to say that a pension can only be paid to a death benefit recipient. So, a death benefit beneficiary. Who is a death benefit beneficiary? It is a spouse, a person in an interdependent financial relationship, or a child under the age of 18 or 18 to 25 in full-time education, or a child who is disabled. So, going back to that again, a death benefit can be paid in the form of a pension to pension recipients. There is no requirement for this to be a reversionary pension. Any death benefit can be paid as a pension. If I'm 54, which I virtually am, and I have a wife who is 38, which go Peter, then, and I die, my death benefit can be paid as a pension to my wife. Now, I'm under 60, my wife's under 60, so the pension is taxable with a 15% rebate. A death benefit has to be paid as soon as practical, either as a lump sum or as a death benefit pension. So my wife's death benefit pension is either paid as a pension or a lump sum. She can't commute that pension back to accumulation phase. So once we start paying it as a pension to her, she can either continue to pay the pension or it must be paid out as a lump sum to her. But remember, any death benefit can be paid to a death benefit recipient as a pension. It doesn't need to be a reversionary pension. It just simply becomes a death benefit pension. Now, with a reversionary pension, if it's a reversionary pension, so I've got a pension set up and I'm 75, my wife's 73, and I die and my super balance is $1 million when I die. That $1 million hits my wife's transfer balance account as a credit in 12 months from the date of my death. However, if it wasn't a reversionary pension, so let's say I'm 75 and I die, and then 6 months later, my death benefit starts being paid to my wife. So when my pension ceases when I die, and my account then automatically reverts back to accumulation. We then totally pay that benefit as a pension to my wife 6 months later. Now, because it's all being paid as a pension, then that $1 million is still considered as assets supporting a pension during that 6 months. So we don't have this tax problem of, oh, we're in accumulation for the next 6 months. It's only in accumulation to the extent that it's paid out as a lump sum rather than as a pension. So remember that one as well. That's in the definition of superannuation income stream in Reg 995.01 of the Tax 97 regs. So we've talked about that the commuted amount can't remain in super because a death benefit can only be paid as a pension or a lump sum. So it has to come out of super as soon as practical if it's commuted. So an example of a reversionary pension. Theodore, and this is the exact example that is used in the Law Companion guideline. So Theodore commences a super stream on 1 October 17, so last year. The rules of the fund allow for the pension to revert to a beneficiary as a reversionary pension. So the rules of the fund are drafted in a way that will allow you to do reversionary pensions. And you need to be careful here because I had a client come to me and he said, oh, I've set up a reversionary pension. This is actually the client I talked about that died, and the accountant said, I did a reversionary pension. And so I had a look for him and he hadn't updated his super fund deed and there was no provision in the deed for reversionary pensions. And I said, well, a reversionary pension is a pension where the trustee has no discretion. You actually do have discretion, so it's not a reversionary pension. In the end, when we go through the non-reversionary example, you'll see it didn't turn out to be a problem, but he thought he had a reversionary pension when he didn't. And then Theodore dies on the 1st of January this year. So he started on the 1st of October and he dies on the 1st of January this year. So Valerie is Theodore's wife, and Valerie is the reversionary pensioner on Theodore's pension. So we've established it correctly, the deed allows it, and therefore upon the death of Theodore, then Valerie is now the owner of that account. So if Theodore's got a binding death benefit nomination to somebody else, that binding death benefit nomination is probably still valid. But if all of Theodore's superannuation was in this reversionary pension, he now has a zero balance. And so the binding death benefit nomination may well be valid, but it's irrelevant because he no longer has a balance, because under the deed, all that money now belongs to Valerie. Now, the start day of the pension for Valerie, what's relevant here, is the 1st of January. It's on Theodore's death. So that's considered the starting day of the reversionary pension. So it moves to her on the 1st of January. Now, at that point in time, the value of that pension was $1 million. Fantastic. On the 1st of January 19, which is a year later, there is a transfer balance credit transaction onto Valerie's transfer balance account of $1 million. So she's got a year to get her affairs into order. Now, let's say that Valerie had an account-based pension of $1 million running at the time. And so now on the 1st of January 19, we report another million. She's actually at $2 million. Remember that we can't actually commute back a death benefit pension. So the new pension, the reversionary pension, it can't go back to accumulation phase. It must be paid out as a lump sum. But her old pension, the account-based pension, most certainly can be commuted back. So we would suggest in that situation, and it will probably be too late, but we would suggest that you commute back the account-based pension and lodge a T-bar to say that it's commuted back, so that you don't get a commutation authority on the death benefit pension and have to take it out of super. So remember, that's with the reversionary pension that happens a year later. Now we'll look at a non-reversionary pension, and you'll see that it's not a great deal different really in practice to the reversionary pension. So again, this is the example from the LCG. Nathaniel commences a pension worth $1.4 million on 1 October 17. It doesn't matter whether the rules say it can revert to another person or not. The fact is he hasn't nominated a reversionary, and he's just basically saying, do what you want, trustee. Chances are his wife is the other trustee. Does he care what she does with the money? Absolutely not. So he'll leave it up to her to decide what she wants to do. He dies on the 1st of January 2018. Now, at this point in time, on the 1st of January 18, his fund is worth $1.3 million. Melina is Daniel's only spouse. She's the other trustee, and it's his only beneficiary. On the 15th of June, we'll say that Melina decides to pay Nathaniel's death benefit as a superannuation income stream to herself. At the time of making this pension resolution, then the balance of his account had gone up $5,000. So it was now actually worth $1,305,000. So on the 15th of June, we have a death benefit pension commencing of $1,305,000. So that is the start date of the pension, and it's also the date that the transfer balance credit happens, 15th of June, $1,305,000. So as you can see, from the 1st of January to the 15th of June, there's no transfer balance event for Melina at all. So if she also had $1 million in super, what we can do before the 15th of June is she can commute back some of her super to accumulation phase, so that when she commences the pension, she would leave she would leave 295,000 in the pension. She'd commute the rest back, and she would actually leave a balance of 295,000. So, and then she would have a credit of 1,305,000. So she's still at the 1.6. Okay, now what else has been happening in the last 12 months? Related party loans. Stephen and I both deal with related party loans on a daily basis, but on a weekly basis, we're discovering accountants that are actually trying to do things that will cause grief for their clients or that just simply don't comply. So all of you should read PCG 2016-5, but I still speak to a lot of accountants that read and understand that, but think that there's other things that don't really matter. The first one, the most common one that I see, is that you need a written loan agreement. You need to use the RBA interest rate, which this year I think is remaining at 5.8%, but you need to check that each year. Another thing to remember, you must register a mortgage. You can't just create a mortgage. You must register a mortgage. Remember that a mortgage needs to be registered, and you can search that, and auditors will search it. The tax office can search it. Worse still, they can actually search the date it was registered. This is causing a problem for existing LRBAs that had to come into compliance with the PCG before 31 January 17. There's a number of them that never registered mortgages, and now they have to register them. And the date of registration of the mortgage can be searched. It's not shown on a search. And I've had a couple of these come to us recently. And basically, these were ones where it was a new accountant that picked it up and the previous accountant hadn't given the right advice to their client. And we thought, well, the first thing to do is to write to the previous accountant and ask them to fix it. But we also contacted the tax office and said, what's the go here? The tax office said, register the mortgage immediately and let us know that you've done it and you'll be okay. So they had to actually fess up to the tax office that they registered the mortgage. So what we did was we wrote to the previous accountant, said this is a situation that these clients are in. You didn't tell them to register a mortgage. They are now at very high risk of non-arm's length income on these investments and their properties. We have contacted the tax office who have said that we need to register the mortgage now, and we need to actually fess up to the tax office that this has occurred. And we said to the accountant, do you wish to, at your expense, do something else to sort this out for the client? And we put you on notice that if this is non-arm's length income, that we will be claiming any losses against you. So this is what happened. It was actually quite a big firm that we wrote the letter to as well. You must make minimum monthly payments. So this is the way the PCG is worded. Payments are made at least monthly. There's nothing in the PCG that actually allows you to make a one payment in advance, which I believe would be commercial, but monthly payments. So I would suggest that once your client set up a related party LRBA, that they do an auto payment every month of the minimum monthly payment. If they wish to make extra, do it, but set it up with minimum monthly payments. This client that we saw, again, they're in the same position. They hadn't made any repayments. They're under, I don't even think they're under the 70%. And we basically had to journalise non-concessional contributions as a repayment every month for the last 18 months. That's what we had to do to get them through. Must be no longer than a 15-year term, and that's easy enough to sort out. Your written loan agreement will cover that, so it's not too hard. So that's what the PCG requires. What are we finding accountants are doing that's wrong? And so what are we saying you should not do? I've actually had accountants say, if it's a related party loan, do I need a bare trust at all? Yes, of course you do. You still have to comply with the law. You still need a full bare trust set up. Now, here's a bit of a kicker. If you have, let's say I'm the lender to my fund, Peter Johnson, I'm the lender to my fund, and I also want to become the bare trustee because I don't like paying for companies. So I'll make myself the bare trustee and I'll make myself the lender. One of the requirements of the PCG is to register a mortgage. You can't register a mortgage in favour of yourself. You just can't do it. The Land Titles Office won't allow it. You're registered on title, now you want to grant a mortgage to yourself. You can't do it. I don't necessarily think this would make it a non-commercial arrangement, But as you know, in your tax returns now, there is a question: do you have a related party loan? And you will answer that question, yes, I do. Then the question will be asked at some stage, do you comply with PCG 2016-5? And your answer to that question has to be no. And then the tax office will say, well, demonstrate to us how this loan is commercial. You'll have to say, I've complied with all the requirements of PCG 2016-5, other than registering a mortgage because the lender has title. Now explain that to the tax office, how that's commercial. I believe it would be, but you're actually in a position where you have to demonstrate that. I've had clients go, St George only want 5.3%. I'd only want to pay 5.3%, not 5.8%. St George require a lot of other things too, other than just 5.3%. So if you want a commercial arrangement, I say this to my clients: if you want to do 5.3, we need a full St George arrangement. I want personal guarantees. I want a full loan agreement. I want penalty interest rates. I want everything the same way that St George has it. It's just too hard. We're getting clients wanting loans for things other than listed shares and real estate. The most common being a loan to acquire units in a related unit trust. And I actually applied for a private binding ruling for a client because they wanted to do a $4 million arrangement. And what came back from the tax office was there's no demonstration that there is a commercial provider that would allow you to borrow to buy units in a unit trust under this arrangement. And therefore, no, we're saying that this is subject to non-arm's length income. We did actually find a commercial provider, but they wanted about 13% per annum interest. And the client said, well, it's not worth me lending to my fund and then the super fund paying me 13% per annum, because then all the income's coming to me anyway and nothing left for the fund. So it wasn't worth doing it. If you're going to borrow to buy units in a unit trust, find yourself a commercial lender that will do it, get the commercial lender to lend you the money, and then refinance it through a related party. That's the only way you'll be able to show that it's a fully commercial arrangement. I've had accountants say, I just want to lend for the deposit. Their client doesn't want to use all their money, but they haven't rolled over yet, so they just want to lend for the deposit. And the accountant's argument to me is, lots of people can borrow unsecured. It's commercial. But how many people will lend to you unsecured on a limited recourse basis, where the asset that their recourse is limited to you don't even own? So you're going to lend me money to buy a car. You lend me the money. I don't buy the car. Your only recourse was the car that I didn't buy. So there's no way that a commercial lender would lend unsecured on a limited recourse basis to buy a property. So you can't borrow from a member for the deposit. And if you take that one step further, you also can't borrow for the GST, because again, it's a limited recourse loan. You're borrowing unsecured because you can't grant a mortgage until you actually own the property. And then you've got to have a second mortgage, and which bank is actually going to give you a second mortgage. But when you first borrow, there's no security granted. So you can't borrow for the GST either. Both of those situations, the deposit and the GST, require a non-concessional or concessional contribution, whichever way you wish to go. Now, another one I see, everybody that's buying from automated deed providers, I see massive problems for them in the future. If you're borrowing from a related company, not only do you have to comply with Section 67A of the SIS Act, not only do you have to comply with PCG 2016-5, you are a related party to the company. You are borrowing from the company. The company is lending to a related party. The company is required to comply with Div 7A. So your loan agreement must comply with Div 7A. Now, at the moment, we're quite lucky because the Div 7A interest rate is lower than the PCG interest rate. The Div 7A term is longer than the PCG term. So provided you comply with the PCG, you will almost certainly comply with Div 7A, but it needs to be in your loan agreement. So you need a loan agreement that is a merger of Div 7A and the Section 67A requirements. So if you're just going online to whoever and buying yourself a loan agreement and you've got a company in there and you've done nothing about Div 7A, you have a potential situation where your super fund has received an unfranked dividend from the company. Now, that's non-arm's length income to the super fund, and there's no franking credits. if you've got one of these, and I know there's people listening to this webinar now that have these, contact us so that we can fix that loan agreement for you. Okay, thanks everybody. We're now going to move towards questions, and we have about 10 minutes for questions.
If you do want to send further queries through, please feel free to do that. You can send them to acis@acis.net.au or to legalservices@acis.net.au. You'll also see our 1800 phone number on the screen in front of you, so you can give us a call. Feel free, and we look forward to doing this again. Cheers.